If the Social Security Administration looks at your bank account and sees the wrong number, your monthly check can stop. Not reduced, stopped. And most people don't find out until the payment simply doesn't show up. Here's the part almost nobody explains clearly. This isn't about your regular Social Security retirement check, and it isn't about SSDI. Those two programs do not look at how much money you have in the bank. What we're really talking about is SSI, Supplemental Security Income. And if you or someone you love receives SSI, or if you're not 100% sure which type of benefit you're on, you need to hear this all the way through. Stick with me, because there's a specific dollar number the SSA is watching for. There are things in your account that don't count against you at all, and there's one common mistake that catches people completely off guard. We'll get to all of it. Why this matters. SSI is different from other Social Security programs. Retirement benefits are based on your work history. SSDI is based on your work history and your disability, but SSI is based on financial need. That means the SSA doesn't just look at your income, it also looks at your resources. And your bank account balance is one of the very first things they check. If your resources go over the limit, even for 1 month, your SSI payment can be suspended. And here's the detail that surprises people the most. It doesn't matter if the extra money came from a gift, a tax refund, back pay from another benefit, or even help from a family member. If it sits in your account and pushes you over the line, the SSA can treat it the same way. But before you start worrying about every dollar in your checking account, there's something important coming up, because not everything you own counts against this limit. Let's break down exactly what the SSA is looking at. The actual number the SSA uses. For SSI, the resource limit is $2,000 for a single person and $3,000 for a couple. That number has stayed the same for a long time, which is part of why so many people get caught by surprise. It hasn't been adjusted for inflation the way monthly payments have. Resources include things like cash in your checking or savings account, stocks and bonds, certificates of deposit, extra property you own beyond your home. If your total countable resources go over that limit on the first moment of a calendar month, that month can affect your eligibility. This is why timing matters so much. Imagine you receive a small inheritance on the 28th of the month. Even if you spend most of it by the 5th of the next month, the SSA looks at what your resources were at that first of the month snapshot. That single moment can trigger a problem. Now here's where it gets a little more hopeful, because not everything counts. What does not count against you? This is the part most videos skip completely, and it's arguably the most important part. The SSA does not count the home you live in, regardless of its value, one vehicle if it's used for transportation, household goods and personal belongings, a burial plot for you or your immediate family, up to a certain amount set aside specifically for burial expenses, life insurance policies with a very low face value. There's also a newer option that a lot of people still don't know about, the ABLE account. If you became disabled before age 26, under current rules, you may be able to open an ABLE account and save money in it without that money counting toward the SSI resource limit, up to a specific annual contribution amount. This was created specifically so that people with disabilities aren't punished for trying to build a small safety net. So before you panic about a number in your bank account, ask yourself, is this actually a countable resource? Or is it one of the things SSA is required to exclude? That distinction changes everything. But even with these exclusions, there's still a mistake that trips up thousands of people every single year. And it has nothing to do with how much money they have. The mistake that catches people off guard. Here's the scenario. Someone receives a lump sum. Maybe it's a retroactive payment from another benefit, a settlement, or money from a family member trying to help with rent. They deposit it into their account, planning to spend it down over the next few weeks. But because of the timing of the SSA's monthly snapshot, that money can be counted as a resource before it's spent, even if the person's intention was never to keep it long term. This is exactly why the SSA gives you a reporting window. If you report the change and spend down the excess resources within a specific time frame, in many cases you can avoid a full month of suspended benefits. But if you don't report it, or you report it late, that's when the SSA can suspend the payment first and ask questions later. There's another situation worth mentioning here, and it involves families. If a parent applies for SSI on behalf of a child, or if someone is married, the SSA can deem a portion of the spouse's or parent's income and resources as belonging to the applicant. This means a spouse's savings account, even if it's technically not the SSI recipient's own money, can sometimes affect eligibility. We'll talk more about how deeming works and who it applies to, but the key point right now is this. It's not just your own name on the account that matters. How the SSA actually finds out. You might be wondering how the SSA even knows what's in someone's bank account in the first place. It's not guesswork, and it's not random. The SSA uses something called the Access to Financial Institutions Program. Through data sharing agreements, they can verify account balances at banks and other financial institutions during reviews. This isn't a one-time check when you first apply. It can happen again during periodic redeterminations, which are reviews the SSA conducts to confirm you're still eligible. This is exactly why keeping accurate, updated records matters so much. If your bank balance briefly went over the limit and you didn't report it, that gap can show up during one of these reviews, sometimes months later. And that can lead to a request for repayment of benefits the SSA believes you weren't eligible for during that period. Here's the reassuring part though. This isn't designed to catch people who are doing everything right. It's designed to catch resources that were never reported. If you stay proactive and report changes as they happen, you're already doing the one thing that protects you most. What you should actually do. Let's make this practical. If you receive SSI or you're helping a parent or family member who does, here's what actually matters. First, know your exact resource limit, $2,000 if you're single, $3,000 if you're a couple, and check where you stand regularly, not just once a year. Second, understand what's excluded. Your home and one vehicle are safe. Personal belongings are safe. A modest amount set aside for burial is safe. Don't assume every dollar counts against you. Third, if you receive a lump sum of any kind, report it right away. Don't wait to see what happens. Reporting promptly is what gives you the option to spend down excess resources properly instead of losing a month of benefits outright. Fourth, if you or a family member has a disability that began before age 26, look into whether an ABLE account makes sense for your situation. It's one of the few tools that lets you save without immediately threatening your eligibility. Fifth, if you're married or you're applying for a child, understand that deeming rules may apply. It's worth asking directly what income and resources the SSA will count in your specific case, rather than assuming only the applicant's own name on the account matters. A real-world example. Let's say Linda receives SSI. Her uncle passes away and leaves her a small inheritance of $2,500. She deposits it into her checking account, planning to use part of it for a much-needed home repair. Because her account now holds more than the $2,000 resource limit, and because the money is sitting there on the first day of the following month, this can affect her SSI eligibility for that month, even though she never intended to keep the money long term. If Linda reports this right away and works with the SSA to spend it down appropriately, for example, on excluded resources like necessary home repairs, she may be able to avoid a full suspension. But if she simply deposits it and says nothing, assuming it's her money to do what she wants with, she risks a much bigger headache down the road, including a request to repay benefits she received while technically over the resource limit. This is the exact kind of situation that catches good, honest people off guard. Not because they did anything wrong, but because they didn't know the rule existed. What this does not apply to. I want to be very clear here because there's a lot of confusion online. If you receive standard Social Security retirement benefits, or SSDI, based on your work record, your bank account balance does not affect your eligibility. There is no resource test for those programs. The only thing that can affect SSDI is your ability to work and earn above a certain limit, which is a completely different rule from what we've covered today. So if you're on retirement benefits, or SSDI only, and you don't receive SSI, this specific resource limit does not apply to you. This distinction matters because a lot of alarming headlines blur SSI, SSDI, and retirement benefits together, making it sound like every Social Security recipient is at risk over their bank balance. That's simply not accurate. If you're not sure which benefit you receive, checking your award letter or your online Social Security account will tell you exactly which program you're under. Dot here, quote, what to remember. If you receive SSI, the resource limit is $2,000 for an individual and $3,000 for a couple. Your home, one vehicle, personal belongings, and a modest burial allowance don't count against that limit. A sudden deposit, even a well-meaning gift or an inheritance, can temporarily push you over the line if it's not reported and managed properly. The SSA can verify your bank balances through financial institution data matches, especially during periodic reviews. And if you're married or applying on behalf of the child, resources belonging to a spouse or parent can sometimes be counted too. None of this is designed to punish people who are simply trying to get by. It exists because SSI is meant for people with limited income and resources, and the rules are there to keep the program targeted correctly. The best protection you have is simple. Know the limit, know what's excluded, and report changes as soon as they happen. If this helped clear up some confusion about your benefits, do yourself a favor and hit like on this video, subscribe if you haven't already, and turn on notifications so you don't miss the next update that could affect your payments. Stay informed, stay prepared, and I'll see you in the next one.